Welcome to The Explainer. Today, we're putting the agricultural giant Corteva on trial through our ultimate guru gauntlet. As an investment analyst, I absolutely love stripping away the daily market noise and applying the legendary time-tested frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham directly to the raw data. We are going to see exactly how this $58 billion company stacks up when pushed through these extremely rigorous, distinct investing philosophies.
Okay, here's our roadmap. First, we'll get a snapshot of Corteva. Then, we run it through the Warren Buffett lens, followed by the Peter Lynch lens and the Benjamin Graham lens. After that, we look at discounted cash flow and alternative valuations before wrapping it all up with a final synthesis and recommendation. Let's dive in.
Section 1. Corteva, a company snapshot. Here are the critical stats right out of the gate. Corteva is trading at $87.25 a share. It carries a pretty steep PE ratio of 51.31, which, spoiler alert, is definitely going to be a hurdle for us later on. But look at that balance sheet. It boasts an incredibly clean debt-to-equity ratio of just 0.07. Plus, they recently beat first quarter consensus earnings estimates by an impressive 32 cents, posting $1.50 in EPS. Beyond just the financial numbers, though, we really have to understand the business itself. Corteva is a massive global pure-play agriculture company. They don't just sell seeds, they drive global crop health through advanced genetics and crop protection chemistries. And right now, there is a massive catalyst on the horizon. They're actively preparing to spin off their advanced seed and genetics business, which will be branded as Vylor. That's expected in the second half of 2026, and it's a huge transformative moment for their capital structure. Moving right along to Section 2, the Warren Buffett lens.
So Corteva actually passes Buffett's qualitative tests brilliantly. Their premium, technology-enabled seeds have really high switching costs for farmers. That creates a highly durable economic moat with strong pricing power. Management is showing incredible execution here too, hitting a record 22% operating EBITDA margin, closing out last year with $3.85 billion in operating EBITDA. When you pair their near 10% return on equity with practically zero debt stress, this is exactly the kind of resilient, cash-generating business Buffett just adores.
But we have to focus on that isolated number for a second, the PE ratio of 51.31. This is where Buffett would absolutely pause. He demands a strict margin of safety, right? To calculate a truly attractive entry point, an investor applying Buffett's discipline would need this multiple to contract significantly closer to historical market averages. At this premium, it's a wonderful company, for sure, but it's currently lacking that fair value margin of safety he requires. All right, Section 3, let's look through the Peter Lynch lens. Lynch would likely categorize Corteva as a stalwart. Basically, it's a massive, stable, $58 billion entity that anchors a portfolio. However, it is showing some serious flashes of a fast grower. In their recent Q1, they reported 11% revenue growth overall and a massive 21% spike in seed sales, specifically down in Latin America. It is pretty rare to see a stalwart flex that kind of regional muscle. Now, the crucial point here is the tension in Lynch's specific metrics. Lynch loves virtually non-existent debt load and management buying back shares, and Corteva has a $500 million share repurchase plan for the first half of 2026. Furthermore, our sources note institutions are making massive bets on the stock, which is a dynamic Lynch tracks very closely. But then we look at the PEG ratio, price to earnings relative to growth, which sits at 2.67. For Lynch, a PEG over 1, let alone 2.5, signals that the stock's price is currently outpacing its actual earnings growth rate. Let's shift to Section 4, the Benjamin Graham lens. This one is notoriously unforgiving. Running down Graham's defensive investor checklist, Corteva easily passes on size with its $58 billion market cap. It passes on strong financial condition with a current ratio of 1.47 and a quick ratio of 1.03. That means liquidity is excellent. It also passes on earnings stability, but unfortunately, it completely and spectacularly fails Graham's requirement for a moderate valuation multiple. And this brilliantly illustrates Graham's strictness. Let's actually run his famous intrinsic value formula. We take the square root of 22.5, multiply that by the expected EPS of 3.72, and since the exact book value per share wasn't explicitly provided, we're plugging in an industry standard proxy of $37. That math spits out a fair value landing near $55. At an $87 current price, Graham wouldn't just pass, he'd probably lock his wallet in a safe and run the other way.
On to Section 5, DCF and alternative valuations. Let's look at the objective cash flows. Using institutional-grade model data from Ticker, we can build out a base case DCF. The inputs forecast a highly modest 2% revenue growth rate through 2035 and a 15% net income margin. To complete the model, we assume a standard 8% weighted average cost of capital, or WACC, and a 2% terminal growth rate to reflect long-term inflation. Keep in mind, these growth inputs are extremely conservative, especially given that recent 11% quarterly revenue bump we talked about. Now, when we run the sensitivity table, varying our assumed discount and terminal growth rates, the base case actually spits out a fair value price target of $103 per share. That implies a roughly 28% upside from today's trading price. If we lower the WACC to 7%, that target stretches all the way up to $118. The cash flow generation here is undeniably massive. However, when we apply some alternative valuation models, specifically a comparable PE analysis, the narrative flips right back. Corteva's 51 multiple towers over standard agriculture industry averages, which traditionally hover around 20. Furthermore, if you look at a reverse DCF, the current price implies growth rates much higher than their historical baseline. This suggests a pretty significant premium for that upcoming Vylor spinoff is already heavily baked into the stock price.
Finally, Section 6. It's time for our synthesis and final recommendation. Looking at our master summary matrix, we see a really fascinating split. The value-focused gurus, Graham in particular, but Buffett and Lynch as well, demand a lower entry price or multiple contraction, landing them firmly on a hold or a sell. Meanwhile, the forward-looking DCF model signals a strong buy, with a target of $103 based purely on the sheer volume of projected free cash flows. So the core takeaways are abundantly clear. Corteva is an incredibly high-quality business, achieving record 22% operating EBITDA margins and having zero debt stress makes it an absolute fortress. Plus, that impending Vylor separation in 2026 is a huge catalyst. But the risk lies entirely in its premium valuation. A 51 PE leaves zero margin for error if global crop cycles turn or if competitive pricing pressures in places like Latin America start to compress those margins. So, I'm leaving you with this final thought today. Is Corteva's dominant market position, incredible balance sheet, and the upcoming Vylor spinoff worth paying a massive premium for right now? Or does our guru gauntlet prove that patience, waiting for that Graham or Buffett-style margin of safety, is still the ultimate virtue in investing? The math is on the table. The next move is yours.